Hey, what's going on, guys? It's CJ Investing here. Welcome back to my channel, and welcome to another edition of Sunday Walks with CJ. I got my wife with me again as well. She kind of driving me crazy. I'm just playing. I love you, baby. But I just want to talk about. She playing shy, y'all. I just want to talk about as far as I guess my goals and my aspirations for my Roth IRA account, what positions I plan to add, things like that. So we're going into April as the recording of this video. I don't know when I'll get it out, but it'll be soon. But just want to thank y'all for tuning in again. Make sure to like, comment, and subscribe. Let's get into the video. So, like, my last dividend that I received was T. Rowe Price. It's my biggest dividend ever. As you know, my T. Rowe Price is my biggest position, my Roth IRA. So it was like a $12 and some change. So it's a pretty big dividend, at least for me. When I got it, I thought I was rich, but it's not but a $1,000 investment in T. Rowe Price. As you know, I believe in that company. As far as the retirement space, I got into T. Rowe Price because it was at a good valuation at the time I was thinking about buying. I like that as well. I really like BlackRock as well, but it wasn't at that price point when I wanted to buy. T. Rowe Price has a huge dividend, over 4%, almost 5% yielding. And stock price is, last time I checked, it was around like $120. So it's came up quite a bit in price. I'm up quite a bit, maybe like 12% on my position. I'm only buying that when it goes below $100. So $90-ish, I'm buying more. Just my weekly purchase amounts. I normally purchase amounts in of like $20-ish, and as you know, I personally reinvest my dividends myself. I don't have the reinvestment feature turned on because, as I said before, I get more satisfaction, I get more enjoyment out of doing it myself. Also, I feel like it's a shopping spree. So I do that. I like stocks where I get paid to hold them. That's why I call myself a dividend investor. But that's not all I look for. So don't get it misconstrued, because I look for value as well. I look for many things. I could tell you. So I look for, of course, more assets and liabilities. Of course, I made an exception for Starbucks, but Starbucks is like a great business, whenever you think of coffee, you think of Starbucks, and people are addicted to that. So I'm not really too particular when it comes to certain type of companies with a strong dominance, a strong brand, and that people are addicted to. Starbucks ain't going nowhere. But anyway, so I look for more assets and liabilities, as well as a lot of free cash flow. On the statement of free cash flows, I just want to know that it has more than enough free cash flow to cover its dividends, to pay down debt if it has debt. If it doesn't have debt, that's another plus. Many companies in the market are very rarely debt free. So there's that. And that it can do share buybacks, where it buybacks its own stock, to where it increases your investment, and it's not diluting you by issuing more shares or putting more shares into the market. So I want to know that it's buying back his shares in a good amount, quarterly or yearly. So I look for that, as well as I said before, dominance in the market. I want to know if it's a monopoly or duopoly. Because if it's that, like say for instance, Visa, MasterCard, Microsoft, Apple, like those type of companies, I think I think they just take over their market. And we make a lot of exceptions for those because nobody's really breaking in the market and taking them on. They have really strong brands, really strong financials. So they're basically duopolies to where like you want a stock or a company to where the government is thinking about breaking it up, or the government is almost trying to prevent it from purchasing other companies because it's already so big. So you want companies like that. So that's a good thing. Let's go on to the other side of the street. I'll protect you, baby. You could go on this side. She just talking nice about me because she on camera, but when the camera go off, she start hitting me and stuff. I just want to let y'all know. I'm just kidding. But where was I at? Yeah, so dominance, presence. I look for that, and like if it's buying back the shares, as I said before. And I also look at management. How good is the CEO? Does he really know his stuff? He really know what he's talking about? Is he a Elon Musk type of CEO where he's on social media and stuff and he's more visible to the public? Or is he more of a quiet down low? We like quiet down low CEOs that kind of stick to their business. They don't talk too much. You know, typically older guys, real nerdy. we like them type of CEOs. They're really passionate about what they do. So nerds are awesome. That's a good thing. But yeah, those are the things that I look for in the stock. I am, excuse the noise in the background. They're having a party right there behind me. But so guys, just to add to that, some things that I also look for in my companies whenever I choose them is how they stack up against their competitors. What incentives or advantages do they have over their competitors? You know, like for as far as in the beverage sector, I would go with Pepsi over Coca-Cola because Pepsi, they're more diverse of a brand. And I think even though Coca-Cola is a stronger brand, with Pepsi, I like, I like just how much of the market that they have. They're in the chip sector as well as in the beverage sector, and the list of brands just goes on and on. And they're highly competitive with each other. They're also kind of like duopolies, what I mentioned earlier as well. So I look for Home Depot over Lowe's. Of course, they're increasing the dividend at a higher rate. Lowe's might be slightly more intrinsically undervalued as far as with its stock valuation, but I like Home Depot a little bit better. Again, I'm a little bit biased in terms of that. I've been around it all my life and I had good experiences and good management and stuff regarding that, good customer service. So I like Home Depot a little bit better in that aspect. Visa, I stated before, I'm biased. A lot of companies, you could be biased with a lot of different companies as long as you you're still able to choose great companies. There are plenty good companies out there, but there are very few great companies, and you want monopolies and duopolies. As I said before, you want to feel as though the government is questioning them whether they can keep them together or not, because they're so big of a company and it's hard for other companies to come up under it. So I look for that, as well as I also look for, that's pretty much everything. You know, I don't have to use the company's products that I invest into. I thought about that some years ago. I'm like, I'm just gonna invest into the companies that I use, but that's not the best strategy, in my opinion, to go about investing, because a lot of times those won't be the best companies or the companies that will have the most growth. So companies that I'm looking at with a lot of growth or double-digit growth, which is another thing I look for, I want them to be growing at a high rate. So like United Health, Starbucks. Even though I don't go to Starbucks, I don't have United healthcare coverage. I understand that they're great investments and they're at great valuations at the moment. I said before, United Health is at $490. Now it's at like $450. It's came down a lot. I'm recording this on a different day, maybe about a week later. I just wanted to add to it. But other examples of companies that might be growing at high rates are VICI Properties, fairly new company in the real estate REIT sector, real estate investment trust. That's what REIT stands for. And very high dividend, as companies in that sector pay very high dividends. So I also look for that. So I look at high growing dividend rates. Are they increasing their dividends at higher rates? Or they CAGRs, CAGR? Are they increasing at double-digit rates? Are they growing their company or business at high rates? You know, things like that make a great investment. And when you buy at a quote-unquote cheap valuation, it makes it even better. You increase your chances of returns in the future. And we plan for the long term, not the short term. So we plan to hold it for as long as possible. But if something comes up, or if we seek more value elsewhere, we'll move that money elsewhere. But we're not completely pulling the money out of the account. Fidelity is a great brokerage. I've had them since 2020. They're not sponsoring this, but I really love that brokerage. It's very professional interface and everything like that. But I think dividend investing or dividend value investing is, you know, the way to go. I like to get paid to hold companies, so I could get money that I reinvest back into it without selling out of the company completely. I don't know, it's just me. Everybody has their investing preferences. Some people prefer purely value investing with no dividend. You know, the company investing the money back into itself without paying dividends. But I feel like at a certain point that they're going to want to reward their shareholders in a different way, through dividends, where they find they can't grow as much anymore. They're more mature in their life cycle, so they tend to do that. And they tend to do that to attract more investors to their stock. Example, Meta platforms. They pay a very small dividend. They just started paying, I think, at the beginning of 2024. But, you know, which I didn't expect. You know, I expected Google to pay over Meta. And I've been waiting for a Google dividend for a long time. Not to say Google ain't a great stock, which is it's good. It's a great company. The stock is good. I just find at the moment better investments elsewhere, which is why I'm investing the way I'm investing. Like I say, Visa, MasterCard, American Express, those are other examples that companies that are huge. I know you know them, and I happen to have a Visa card, as I'm sure a lot of you out there have one of these cards. They're just growing at a high rate. It never ceases to amaze me how they're able to grow at such high double-digit rates and be such large companies. But they are, even though the dividend is minuscule, it's very small, they're increasing at very high rates. They're beating the rate of inflation by a long shot. Probably Visa is my second largest position in my portfolio. It's basically like my favorite stock. Even though T. Rowe Price is number one in my portfolio, it got that way because it was trading cheap at the time and I wasn't buying Visa because they had came up so much in price, and I had bought a lot of shares when it went under 200, which was about a year and a half ago, you know. Visa is also my oldest position. So I love T. Rowe Price a lot. It has a very high dividend and it's still growing at good rates. And it's one of the cleanest balance sheets that you're gonna find in the stock market. When you think clean balance sheet, you think T. Rowe Price. It's just very well run. If you can't stand volatility like that, which it's not very volatile, but it does kind of track the market because, you know, T. Rowe Price manages people's money and tied into the market, the stock market, retirement. They have their own ETFs, which are exchange traded funds. Yeah, I think that part of their business I'm optimistic on as well. I think that sector will grow more popular in the future with their ETFs and everything. But I'm optimistic on them. I like Visa better though. But all great companies. I hope to own Home Depot at one point in time. I really like Home Depot, and it's not going anywhere. It's tied to real estate, you know, interest rates and things like that. The need for people to fix up their homes or improve them. You know, I think that'll always be there. As long as people own homes or houses, they're gonna want to fix them up and make them better, increase the value in it, you know, do things like that. And I think Home Depot, as well as Lowe's, but I prefer Home Depot. I had an issue for a long time with their debt. They're a business that has a lot of debt, but as I saw as of recently, they've been paying it down. So I really like that, and it's manageable for them. They have a strong brand, a lot of free cash flow, a whole lot of free cash flow. I mean, they're comparable to credit card companies with the amount of free cash flow they have. So that's really, really awesome. They won't be in any trouble. They're gonna do just fine going forward and continue to grow. People are gonna need and want for them. I stated in the last video about I wanted to own NextEra Energy at some point. You know, I'm kind of torn on that sector because I don't like a lot of debt. They have more liabilities than assets. It's just heavy debt carrying businesses and sector. I just don't have a big need to have them. You know, I could do just fine with my Starbucks, my Visas, my T. Rowe Prices. I even have Realty Income for a monthly dividend payer in my portfolio, which I refuse to let go stubbornly. It's not a whole lot of growth in that company. It's very mature business. You know, it's hard for like monthly businesses, monthly paying dividend stocks to grow. And if they ever cut their monthly dividend, I would probably sell, which I'm sure a lot of people would, and that would send the stock price tumbling down. But I mean, I really want to own Vici Properties at some point. I might trade Realty Income for Vici Properties. I'm just having a hard time letting go right now. There's a lot of Vici fans and stands out there, Discord chats on YouTube and stuff like that. They're really bullish on the casinos. They have a heavy presence in Las Vegas, which I have to do a little bit more research on it. But they're awesome businesses. They own a lot of the real estate out there. And people are addicted to gambling. You want to get in businesses or sectors where people are addicted to. And even if it's not a necessity, it's not going nowhere. It's a growing sector. It's a growing businesses out there, real estate, and it's not going anywhere. Billions of dollars get invested into that area every year. I really like T. Rowe Price as well as Visa. Visa is a company that you can buy at pretty much any price. I said that before. I prefer it over MasterCard because of its valuation. It's always traded just a little bit cheaper, as well as I'm a little bit biased because I've always owned like Visa cards. So I want to own, like I said, United Health before, because it's a strong presence in the health insurance industry. It's at 490, 494 or something like that right now. I needed to come down to maybe 470, 460 before I think about even starting a position. And I'm all right if it keep going up. I just won't buy it. I continue to buy what I have in my portfolio, and I can continue to dollar cost average into that. So I basically buy on a weekly basis what's down, what's below my cost average, or what I want to own more of. But yeah, I want to wish y'all the best with y'all investment journey. It's just a short video, just sharing my thoughts on the Sunday walk. I appreciate you all for tuning in. Make sure to like, comment, and subscribe. And I will catch you on the next one. Love y'all. Peace.